Welcome to FYI, the Four-Year Innovation Podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
ARK Invest is a registered investment advisor focused on investing in disruptive innovation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. It does not constitute, either explicitly or implicitly, any provision of services or products by ARK. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK or podcast guests, and are not endorsements or recommendations by ARK to buy, sell, or hold any security. Clients of ARK Investment Management may maintain positions in the securities discussed in this podcast.
From ARK Invest, this is FYI, the Four-Year Innovation Podcast. I'm Brett Winton. We've got a great episode for you today. Today, Cathie Wood, our CEO, CIO, and fearless founder, is interviewing Don Wilson of DRW and Cumberland, founder and CEO. So Cumberland was an early entrant into, or DRW was an early entrant into crypto and founded Cumberland, and has helped build Canton, which is institutional blockchain rails for TradFi asset settlement. So Cathie and Don discuss how this faster on-chain settlement and collateral mobility will occur. They also have some spicy takes on whether or not minor extractable value is actually not the same as payment for order flow. Maybe it's illegal. And talk about kind of public versus private blockchains and why you may need to be able to control the transparency of the settlement layer in order to enable true uptake of TradFi assets onto blockchains. So the DTCC, basically the clearing corporation for traditional assets, has announced they're using Canton as their settlement layer, at least for their tokenizing treasuries on Canton. And it's an emerging, now permissionless blockchain that could be pretty interesting as the world goes on chain. At a high level, we think that around by 2030, 5% of global financial value will be tokenized. This is roughly matched against the penetration of the internet in the dial-up days, the early internet. And even that would be monumental because we think there's going to be $1 quadrillion of financial assets globally by 2030. You don't have to make a huge stretch to get there. So you take 5% of that, you end up with an obscenely large number, and there's a lot of money to be made providing the underlying blockchain infrastructure that facilitates those tokenizations. It's also interesting to think about the macroeconomic impact of tokenization. So if you tokenize an asset, right now on all the financial assets out there, financial intermediaries collect on the order of 3%, a little more in gross revenues per financial unit of wealth in the economy, financial dollar of wealth in the economy. And so we think that the underlying protocols are going to be able to operate successfully collecting just 1%. So it's actually a very meaningful savings to the real economy relative to financial intermediaries as that happens. And then as Don talks about a little bit, once an asset is tokenized, it also becomes more useful. So not only do you save on the fees you would otherwise pay out to kind of the money center banks of the world, you also then can more efficiently use that capital either by collateralized borrowing, and in the case of collateralized or tokenized treasuries, you can do it 24/7 rather than just waiting for the banks or your counterparty to be open in order to convert that collateral into cash that you want to use elsewhere. And so a tokenized asset, not only does it reduce the drag of financial intermediaries on the traditional economy, but it potentially makes the underlying assets more useful, as in you don't have to have as many units of capital held up in holding the underlying asset. They can be more capital efficient. And so please enjoy the episode and the conversation between Cathie and Don Wilson. And I hope you enjoy it.
Welcome, everyone, to FYI, For Your Innovation podcast. I'm here with Don Wilson. And Don and I actually have known each other since 2015. So it's 10 years, Don.
Yeah.
So, yes. So maybe you can introduce yourself and maybe we can talk a little bit about the good old days before we get into some of the interesting developments around DRW and digital assets recently.
I'm Don Wilson. I'm the founder and CEO of DRW, which is a proprietary trading firm and markets innovation company. We also started Cumberland, our crypto arm, in 2014.
Right. And we wrote our first paper at ARK Invest about Bitcoin, our first blog in 2014. And in 2015, we were the first public asset manager to gain exposure to Bitcoin through the only way we could do it at the time, which was GBTC. But Chris Bernisky, who had fallen down the crypto rabbit hole, got to know Cumberland very well. And I met you back then for the first time as we were both exploring this brave new world. And I say that because we certainly faced a lot of, headwinds or backlash from traditional financial institutions, really, completely dismissing the crypto movement at a time when we thought, wow, this could be a revolution. And boy, has it been a revolution.
Yeah, no, for sure. I mean, back in 2014, we were, I think we were the first traditional financial organization that got into crypto in a big way. And, back then we were all having those discussions about, what does it mean? What are the implications? Where is it going? And I still feel like there's still a lot of that discussion going on today. But yeah, that was great in 2015 when we were able to connect and share some of those thoughts at the time.
Well, maybe you can talk about the evolution, your evolution through crypto, and very recently your involvement with the Canton Network. So we can just get the big picture first and then drill a little bit.
We started Digital Asset Holdings with the goal of building, leveraging this technology for traditional financial markets. And they ultimately launched the Canton Network, which is a public permissionless chain with the characteristics that we think are necessary for traditional financial markets.
Yeah. So now Canton is often described as a network of networks for institutions. So what is the core problem in the traditional market infrastructure that you felt nobody else was going to solve and that pushed you to build?
We think the opportunity is to enable the movement of value in a much more efficient and rapid manner, and to better unlock the ability to use instruments as collateral. I think there's also opportunities to extend, the ways in which things trade. But I think that you get a ton of value out of the other parts, the on-chain settlement, and the ability to move collateral, move value more rapidly. So those are kind of the key things that we were thinking about. We think that in order to do that, it's important to have privacy or configurable privacy on the chain that you do it on.
Digital assets is backed by the who's who. I mean, BlackRock, Goldman, NASDAQ, S&P, Citadel, Euroclear, DTCC, and you just made a big announcement there, or they did, Bank of New York. So what are they seeing? I guess they're seeing that they're agreeing with you. Okay, we need all of this to happen more seamlessly, and we must have privacy. Is that correct?
Yeah, that's right. That, the institutions, and I'm not sure BlackRock is on the list quite yet, but yes, lots of others.
I thought
But the institutions are saying, "Hey, we really want to embrace this technology. We see the value of it, but we know that people who are, let's say, buying or selling stocks don't want to broadcast to the world as those transactions either take place or as they settle, any more than whatever information is required to be broadcast. Obviously, price, prices are broadcast, volumes are broadcast, but not kind of, hey, there's an owner of X amount of these shares who has started selling. That leaking that information would result in material slippage in execution, and I think people are very concerned about that. The other thing is being able to configure permissioning depending on the asset, and in some cases, maybe permissionless is fine. But in some cases, you want to kind of constrain how the asset can move and who can hold it. And so that combination of being able to configure privacy and also, configure, the permissioning are important characteristics that these institutions are very attracted to.
Is there any part of this network of networks that involves permissionless at all?
Absolutely. I mean, this is a permissionless chain. Anybody can connect to the chain, build on the chain, do things on the chain. The chain is very decentralized, by the way. There are over 600. There are over 600 validators. There are 32 super validators, and constantly new ones coming on. So it's a quite decentralized chain, and it is permissionless.
But
there's also ability to create permissioning around some use cases on the chain.
Okay, that is really interesting. As I was talking to our crypto team about Canton, I said, well, how is it regarded in the community? And the default was, well, DRW and digital assets are very well regarded, very highly regarded. But a lot of the crypto community does not know much about Canton. And I guess this is one of the things we're trying to accomplish is to, raise the visibility of what you're trying to do. But it also means that I don't know a lot of the details about Canton either. So I'm happy that we're doing this. I guess DTCC just chose Canton to tokenize a subset of US Treasuries held at DTC. And that was, we always look in the early days of an emerging technology or network, who's signing on. It seems to me that was a huge seal of approval. Maybe you can talk a little bit about that because, people in the TradFi world know DTCC, but maybe not in the crypto world. And we're trying to help everyone understand what's going on here.
Yeah, so DTCC is the Depository Trust Clearing Corporation, and they hold about $100 trillion of assets, And so it's treasuries, corporate bonds, municipal bonds, and most importantly, equities. And so what they announced this week is that they are going to tokenize some of the treasuries, basically the most liquid treasuries on Canton. And the way that will work is if somebody who owns a treasury asks the DTCC to, rather than track the ownership of that treasury in their database, to use the Canton Network to track the ownership of that treasury, then they move it over. So that's a really big deal. And they also in the release kind of telegraphed their intention to move on with the with the other assets as well. So it's a really big deal.
It is, and maybe I just don't understand DTCC enough. Why would it do this? Usually an entity that has control over a network, it doesn't really want to hand it off. Is this, maybe you can describe why this is happening and why.
So let me describe a little bit more about the function of the DTCC. So and I think we should talk about it with regard to equities, because that's a really important ecosystem, and obviously there's a lot of focus on tokenizing equities. So in the early days of equities, there were share certificates, and companies would issue share certificates. People would hold their share certificates.
Remember.
And buying or selling the share certificates or borrowing against them was quite cumbersome. And the DTCC became a mechanism to transition those share certificates into onto a database so that they could be more easily bought and sold. And I should mention that there's actually another type of entity in the mix, which is a transfer agent that often sits between the companies and the DTCC. So if a new company goes public, they have to select a transfer agent, and people who want to hold their securities in street name, in other words, be able to borrow against them or readily buy, sell them in a brokerage account. They instruct the transfer agent to move those shares to the DTCC. But some people, maybe the founders who don't want to, who have no plans to sell their shares and want to make sure that they don't get lent out, may just keep their shares at the transfer agent. So the DTCC becomes the place for shares that are able to be bought and sold readily or borrowed against. They're tracked by DTCC's database.
So they're starting with a subset of US Treasuries. As you say, equities is very important. What will be changing for market participants on day one? And I guess looking out there over the next year, what are your expectations in terms of, assets moving onto the Canton Network? How quickly could this happen, I guess, is the
first thing that will take place is treasuries. And so we've done some kind of preliminary trades with treasuries, where there's a nice Bloomberg article a few months ago that kind of describes how we took a treasury that we owned, and we asked DTC to put it onto Canton on a Saturday morning. We lent it to another counterparty. We got USDC in return. And then on Saturday afternoon, we unwound the trade. And there were a bunch of prime brokers and involved in the sequence of transactions. And what that does is it just unlocks the ability to transform a very liquid collateral into cash during non-banking hours. And of course, that's a big deal for crypto markets, which are 24/7. But now I think most markets are going to go to either 24/7 or 24/5. And so as that happens, it's really important to have that collateral mobility and that ability to switch collateral into cash and vice versa.
And I noticed you used USDC as sort of the on-ramp, off-ramp. Did I understand that correctly?
Yeah, that's right. That's what was used in this case. I think eventually people will have a choice of stablecoins on Canton as they do on other networks. But yep.
That's interesting. Just a little bit of a jog there. On stablecoins, I've always thought, that winner takes most, or, that there would be the network effect, and Circle's certainly being very aggressive, and Coinbase as well, which has obviously a vested interest. Do you think that longer term that will be right? That short term, maybe we'll see a lot of issuance of different kinds of stable coins, but longer term, it's probably going to shake out to just a few?
It is a great question. And I think where my head was a year ago was definitely that it would be, kind of a couple of big winners, Circle, Tether, maybe one more. But now I'm not so sure as the ability to switch from one stablecoin to another becomes easier and easier. Maybe there will be a whole proliferation of stablecoins, a bunch of different organizations that are just trying to capture a piece of that risk-free yield, and the building blocks will exist, which they in many places already do, to be able to swap from one to another. So I'm not sure.
Interesting. We're grappling with this day to day here. Okay, then in terms of scaling moving forward, the next year, the next 5 years, just any sizing of the market that you think is relevant to Canton?
I think that most liquid assets will move on chain in the next 5 years. So, DTCC holds $100 trillion of assets. I think that a majority of those will be on chain in the next 5 years. Now, I expect DTCC to connect to other networks, and ultimately it will be, it will be up to the asset owners to decide what network they want to be on, what characteristics they want in a network. I mean, it will also be up to DTCC about which networks they connect to. And of course, as I said, there are other ways of putting things, or on chain, right? The company could issue directly on chain. The transfer agent could issue on chain, or maybe a competitor to DTCC that has a similar kind of licensing could spring up and put things on chain. So there are a lot of different ways that this can go. But one way or another, I do think that a majority of these assets will go on chain, and I think that Canton is very well positioned as a public permissionless chain, but with this configurable privacy and configurable permissioning to capture a lot of these flows.
I think this is becoming clearer and clearer as you talk. But what's interesting is that DTCC, as I understand it, is not only using Canton, it has joined the Canton Foundation as co-chair with Euroclear. So that seems like a big deal.
That is a big deal. Yes. I mean, it's not hard to read the tea leaves there.
Yeah.
That DTCC sees this as a very important chain and one that they want to really lean in on.
Right. And it seems like DTCC believes that that Canton could become the default institutional RWA, real world asset network. Is that what we can glean from this?
I mean, that's my interpretation of it. And by the way, it's also, what I believe. I think that Canton is best positioned to achieve that.
Just a little bit of a jog here. One of the criticisms of tokenization has been this is just wrapping the same assets with more buzzwords. What can you do with a tokenized treasury or money market fund share on Canton that you cannot do in today's market structure? Now, I realize you've already answered some of this question, the use of collateral, non-market hours. Are those the two main ones?
Yeah, I think those are the two main ones, but just to expand on that a little bit, if you own an equity, and right now, if you have a decent account balance and you're you may be able to borrow against your equity, but you can only borrow through the prime broker. If the equity is hard to borrow, you'll still pay the same rate to borrow against it. You won't get any of the benefit of the fact that there are a bunch of people that want to short that equity and are actually paying, a lot of money to short the equity. And so when it's on chain, as the asset owner, you'll be able to, have a wide choice of how you borrow against the equity, and whatever rate you get is going to be the rate that reflects the fact that maybe that equity is hard to borrow, and so you'll derive a bunch of benefit from that. I think that's a really big deal.
Yeah, that is interesting. Very interesting. Again, another little jog, but we just had our brainstorm, which we have every Friday, and we spoke a lot about prediction markets, and we see that Coinbase and Robinhood both made announcements this week about prediction markets. And I think this is going to shift really from retail to institutional in terms of market making and so forth. What do you think about that, and how, and of course, prediction markets will be 24/7 as well. So how do you think about, prediction markets in the context of what you do?
There are some prediction markets that really are kind of carbon copies of what we do. Like, will the Fed cut at the next Fed meeting or not? Right? I mean that's something that is, we trade regularly and have for decades. And so, now it's just in maybe a slightly more accessible form. And then, of course, there are there are prediction markets like how many presents will Santa deliver on the NORAD Santa website this year. And so there's a wide range of things. I agree these markets are going to become more institutional. In some cases, I'm not sure that the NORAD Santa use case is ever going to have that much institutional appeal.
Right.
But yes.
No, I know. But we're trying to noodle through this, and this market is evolving very quickly. And, I think regulations are trying to catch up, or at least try to understand what's going on. So it's fascinating that, they both came out with something this week.
Yeah, and just, before we move off that, one of the interesting things about these prediction markets is most of them are on venues where every single position and trade is transparent. And that's super interesting. I will say again that I don't think that large institutions that are putting big trade, they're essentially derivative trades on, want to broadcast to the world the trades that they're doing. And so there is a prediction market that's being built on Canton because of the privacy. And I think that that's, again, something that will be very appealing to institutions.
Yeah, and that's what I thought you were going to say. And Canton insinuating itself into this new world, which is kind of an old world, as you say. You've been trading instruments on what the Fed's going to do for a very long time. Can we talk about competition? So on the institutional side, I don't know if it's you're competing with or overlapping with private bank chains, and now Circle's ARC, layer one for stablecoin activity. Can you put yourself, Canton, in context there?
Yeah. So first of all, I think the main competition for Canton is actually, the main public chains, right? Ethereum, Solana, et cetera. Of course, it's also the private permission chains and ARC. So my view always, and by the way, Canton started its life as a private permission chain. And we were always clear that that was a holding pattern. Private permission chains are silos. I don't see a long-term use for them. I mean, they're fine for some narrow use cases. They're not all that interesting to me. So I think that those are just, let's think of those as a sandbox for institutions, which is exactly how Canton Network started off, always with the plan to transition it to a public permissionless chain. ARC, and I think some of the L2s that are sponsored by large organizations are, at least they start their lives as very centralized. Some of them have centralized sequencers, which means that they can, that a single party, a single organization can decide to, which transactions they want to let through and which ones they don't. I think that that's a big disadvantage. Large institutions want to have control over what they're doing, but they don't want anybody else to control, to be able to censor their transactions. So, but beyond that, I mean, ARC is obviously very focused on being able to move money across borders. It's not entirely clear to me how they're dealing with the privacy issues, because a lot of people moving money around are concerned about that. And for instance, some of the entities that do cross-border transmittance facilitations using blockchains find that as soon as they move dollar stablecoins to Mexico, that the Mexican peso all of a sudden moves because everybody knows what's coming next, which is just highlights the problem that happens on these when things are completely transparent.
It's interesting. Do you remember, this probably was either 2014 or 15. Do you remember one, which was tried by the various banks?
Yeah, I think it was R3, but yes.
Oh, was it R3? I knew it was R something. Okay.
Yeah.
Okay, R3. It never worked. They for reasons you just said, right?
Yeah. 100%.
So I am surprised. We do own Circle, but I was surprised that they were going to try that again, because it so clearly didn't work. Now, maybe it was an idea before its time, and Circle is going to find some success in some way here. But I think what you're doing here, I think, would be preferential to this ARC concept.
I think for people that want to, or organizations that want to use a chain, they want to use a chain that's truly decentralized, that doesn't have a single entity that can control what they're doing. So yeah, I think from that perspective, it's a big selling point.
Yeah, interesting. Now, I know Digital Asset just raised strategic capital. It was from Bank of New York, NASDAQ, S&P Global, iCapital, and others, specifically to scale Canton. So could you talk about how Digital Asset intends to leverage its position to scale Canton?
There are so many things. I mean, the goal is to obviously make this the go-to chain for global collateral movement and global security settlement, and that's a very large TAM. It takes a lot of resources to do that. Obviously, those are very important ecosystem participants. Bank of New York is actually the primary custodian for United States Treasuries. So super important ecosystem participant, very involved in collateral in general. S&P, obviously a major index provider. I think the opportunities around more efficient ETFs, create, redeem, using tokenized equities is a huge opportunity.
We agree. Yes.
iCapital, a very important feeder fund for private equity. They're already on the chain. They've tokenized tokenized their funds on the chain on Canton. It's one of the reasons that the amount of assets on tokenized on Canton, well, it's in the trillions because of some of those use cases.
The private equity, do you see any ramifications for private equity, private credit?
Absolutely. I mean, private equity and private credit both. There are a number of private credit projects on top of Canton already. That's obviously an asset class that's growing rapidly. Ironically, and we could have a whole nother podcast about it, the potential implication to bank balances if stablecoins take off. So if banks are lending less, then private credit will become even larger. But the workflows around private credit are very inefficient. And so there's a huge opportunity to put the entire private credit industry on top of Canton. Private equity is similar.
It's interesting. The SEC is grappling also with private everything, and how to, on the one hand, the old way of thinking about it, protect retail investors, from inordinate risk. But on the other hand, now that retail investors have been blocked from amazing opportunities to scale their wealth if they don't have enough income or net worth, the SEC under Paul Atkins is trying to figure out a way to democratize for retail investors the private equity, the venture world. Do you see any role for Canton there?
I mean, for sure. I think it's the same reasons that Canton's attractive for public equities. Same thing for private equity. Obviously, it's a lower velocity thing, but still, tracking ownership on chain and being able to move the assets more efficiently, and even being able to get leverage on the assets, using those assets as collateral. Huge unlock.
Yeah, Fascinating. When I was discussing with our team, Canton, and I think we're all trying to really develop our knowledge base here, but one of the questions they suggested, and I think I know your answer now, but given the way you started and how you're evolving Canton, would it be more accurate to describe Canton's endgame as becoming a distributed blockchain or a decentralized blockchain?
It's already decentralized. Anybody can connect to the chain and do things on the chain. Now, there's some control. If you want to become a super validator, you need to go to the foundation and kind of petition to become a super validator. So I think it's already got this nice blend of decentralization with some aspects that are a little bit less. I mean, it's still decentralized, right? But it's
But yes, it's more selective with privacy, the end game. Yeah, so that's very helpful. And what about non-US participants?
Well, the co-chair of the foundation is Euroclear.
Yes. So you think that they will feel comfortable? This is a U.S. entity, right?
Yeah, I mean, that's right. The foundation is onshore, which, by the way, was pretty unusual. Most of these foundations are kind of offshore to avoid regulatory scrutiny or whatever. This is an onshore foundation, but this network is sufficiently decentralized that I think anybody will feel comfortable interacting with it.
Yeah, good. So global, very, very, very big idea.
We were just in the Middle East, and there's a ton of interest in doing stuff on the chain over there as well.
What's been very interesting about the Middle East to me is at least the UAE, they have chosen Solana ahead of Ethereum in terms of the public blockchains, dedicating resources and so forth. It seems to me that is what has happened.
I don't know. They have like 20 different use cases going on, and it seems like they're doing stuff on all sorts of chains.
Oh, you think so? Yeah.
Yeah, okay. That's my sense.
All right. That's interesting because I was getting the sense they were veering towards Solana. So that's given everything we've heard from the retail side. And now you're in the serious infrastructure camp in the crypto world. But what's the one thing that excites you from the more chaotic or retail driven side of crypto that you hope might make its way into the regulated markets?
Yeah. So here, the single biggest thing, and the thing that I think is really cool about, Ethereum and the evolution there and what's happened on Solana is just that ability to build new things and really fast, deploy them and see what happens. That is awesome. That experimentation is great. Obviously, some of them don't work. Some of them are bad ideas, and some of them are good ideas. But that's how life works. And I really hope that we get to much more rapid experimentation in more regulated markets. And I think with this administration, that's what we're going to see. And I think we're going to see a lot of that in the Canton ecosystem.
Yeah, it's a competitive advantage, I think, for the U.S. in a sense to, have this fail fast attitude. And you're right. Those are the sandboxes, Ethereum, Solana, where they try a lot of things and a lot of things fail, but some take and some take in a big way.
A few days ago, we saw this lawsuit about in the Solana ecosystem about pump.fun and MEV and did people have an unfair advantage and all of this kind of stuff? And that's an example of I haven't studied it in detail, but I do know the whole idea of MEV enables people to jump in front of other orders that have come first, or to pay to be ahead of the queue, which I think is an interesting economic model, but may be completely incompatible with how we think about how securities should trade.
Yeah, so you don't think of MEV as payment for order flow, which happens regularly in the traditional
I think it's very different.
Oh, that's interesting. So, yeah, if you could just explain that difference.
So payment for order flow, you're basically saying to, Robinhood or whoever, hey, send us all your flow, and we will, we obviously have an obligation for best execution, and at the same time, we can internalize it, we can route it out, we'll deal with it, however, but we're going to pay you for that because there's value in that process. MEV says, hey, I see that in this next block, there's an arbitrage opportunity, and there's a big seller over here, and then there's a buy order that came in at the same time, and I'm not going to let those orders match. Instead, I want to actually pay to step in front of the sell order and take the other side of that, and then knowing that the buy order now is not going to get filled, and in the next block I can then scalp that out for a profit. And I think that it's more akin to front running, right? Front running is illegal. Payment for order flow is not front running. So I think that MEV is actually, and the definition of MEV when you look in most places, like look on the Coinbase website, how the definition of MEV on the Coinbase website is front running. Front running is clearly illegal and is very different than payment for order flow.
Yeah, that's interesting that you say that, because most people, and it's not my world at all, this is definitely your world, and there are nuances, but payment for order flow, there was the huge controversy around Robinhood and some of the meme stocks and so forth. There is that sense out there that, something like MEV is happening, but you're right, it's not, because front running is absolutely illegal. So,
yeah. Now, by the way, I think that if all orders were just required to be routed to a lit order book, that would be a better world. But that's not the world in which we live. MEV is definitely very different than payment for order flow.
Yeah. Well, I'd be remiss if we ended this podcast without talking about what's been going on in the crypto world. Many people are worried about the 4-year cycle. It's actually happening. Was it? Maybe we hadn't had much of a rally, nothing like we've had in past 4-year cycles. But it seemed like the flash crash on 10/10 could have been a trigger. I don't know. What do you think is going on?
I certainly, at the end of last year, I really thought that Bitcoin was very well positioned to benefit from kind of crypto-friendly administration and of course also the fiscal backdrop of just kind of continued deficits and probably in the long run more entrenched inflation. And so I was certainly surprised by the evolution of the market in the last couple months. And I think looking back on it, some of the rally in Bitcoin was driven by this proliferation of DATs. And obviously then the DATs went into all the other assets. And so there was this kind of like forced buyer of of these things is a little bit artificial, maybe. Um, um, and and then the DATs immediately started trading at a discount to MNAV, or a lot of them did, which then puts this kind of uh, overhang on the market. So I think that that's one of the things that happened. I still think that we haven't come out of that overhang. The other thing is, yes, I mean, October 10th was not a good day. And it obviously it highlighted a lot of weaknesses in the whole market structure of crypto. But I do think that it probably resulted in some pretty big losses, and we probably still are recovering from that as well.
Yeah, I also think when the ETFs, the spot Bitcoin ETFs, came out in, was it early 24? It was January of 24. I think as institutions who have not really been exposed, and they are not really exposed, the traditional ones, in any great way right now, but as they were studying whether or not they should get involved, they heard about this thing called the 4-year cycle. And so, it's been interesting to watch. So David Puel does our on-chain analytics, and he's looking at the market, and he thinks there is an underlying bid that is preventing a much steeper correction. I don't know if you see it that way or not, meaning are institutions legging into this correction, preventing the sort of 75 to 80% drop that we've seen in past cycles?
Yeah, I think that there are a lot of signs that this sell-off is yet again an example of Bitcoin going from weak hands to strong hands. Now, the depth of the sell-off, I'm not convinced that it's over. I think, Cathie, you're kind of the mind that we've seen the lows. The low was 80K, and it's up and to the right from here. I'm a little bit more cautious about it. I can certainly see that scenario, but I also see a scenario where we still have to, go a little bit lower before we rally. But yes, I agree in general with the premise that institutions are buying as we go down, and that will, you're not going to see the same thing of kind of like Bitcoin going to $10,000. That seems very unlikely to me.
Yeah, I guess the working number that I'm hearing, maybe you are as well, is Michael Saylor's or Strategy's average cost, which is $74,000, in and around there. So many, I think, and because I've heard it so many times, the only reason I'm saying maybe we've stabilized here, I'm not 100% sure, but institutions are averaging down. Maybe we will get some news event which will take Bitcoin down to that 74,000. And there you have, I think, a lot of buying activity or buying power as people test that thesis.
Yeah, maybe we'll see. I mean, the flip side could be if MSTR trades at a discount to MNAV.
Yes.
That actually that exacerbates the sell-off.
Yeah. Good. And I'm not, I've been in this market for too long to say, oh no, we've definitely bottomed, because I've seen wild markets before. But I do think, as on-chain analytics support this thesis about institutions, as you call them, stronger hands moving in, that we may have seen the low. I don't know. Famous last words, as I always say. Anyway, well, it's been a pleasure, Don. Thank you so much for educating all of us more about Canton. I think we scheduled this podcast before the DTCC news. And so it's very exciting, first of all, hear the news and to have you put it into context. And so thank you so much, Don.
Well, thank you very much for having me on. Really good to see you, Cathie.
Likewise. Thank you so much.
Thank you for listening to this episode of FYI, the For Your Innovation podcast. If you enjoyed this episode, please hit that like button and make sure to leave a comment down below letting us know what you thought. And if you haven't already, please make sure to subscribe to the show and follow us at ARK Invest on your favorite social platforms so you stay up to date whenever we drop a new episode.
ARK believes that the information presented is accurate and was obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARK. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARK's current views and assumptions, and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.